Hey, David Ellington here. So glad you stopped by. Today's blog is going to be talking about the recession or upcoming recession. I'm coming to you live from Seattle, Washington, where my wife got this amazing vacation rental. And you can see the Cascade Mountains behind me. We're looking west if you look out my window behind me, and it's just a beautiful city. And if you look at this city and other large cities where there are cranes, there's building going on, you kind of wonder, how is this, or how are we heading for a recession? And the bottom line is that there are always leading indicators that point to us going into a recession. One of the biggest ones is the inverted yield curve of bonds, which means short-term bonds are paying a higher interest rate than the long-term bonds are. And there's also monetary policy. There's other factors that come into that. The Federal Reserve can't lower rates anymore to stimulate the economy. So we're probably looking at a recession coming up. With that said, what does that mean for you? One of the things that my older brother John always did, anytime I came to him with a problem or a concern or a question that I had, he would always first say, how does this affect me? And that's really the question you need to ask right now. Because one of the things that you need to think about is, how are your assets positioned to deal with a recession? If you have real estate assets and you have no debt, you're going to be a lot better off. If you have long-term rentals, those are really do typically well in recessions because other people lose their homes and need a place to stay. If you have debt, this is a great time to refinance. You're looking at 30-year mortgages at 3.5% interest. That's crazy. If you have a stock portfolio, I totally agree with not trying to get out or trying to time the market, because most people do a horrible job of that. They buy well, but then they don't know when to sell, and they typically sell low. So don't let your emotions rule you there, but with your stock portfolio, you do want to be smart. And then with bonds, I mean, if you're buying CDs or fixed income securities to try to create income for you, if you're retired, you're in a world of hurt right now because there's not a lot of places to go unless you pay a very high premium for some older bonds. So what does all this mean? Well, number one is that there are options. Insurance companies for years have been investing money in commercial real estate and monetary instruments like they'll buy a currency in another country that's going really strong, like Germany. They also invest in different types of real estate. They invest in stocks, they invest in bonds. And so there's all different things the insurance companies have done because they have to maintain a certain amount of dollar amount to pay the cash value for life insurance policies. Well, a lot of people said, well, hey, I'm not insurable, but I would love to be able to invest in that fund. How can I do that? And they came up with something called annuities. And annuities are ways where you can invest into the general fund of the insurance company and get that higher fixed income return than you could in stocks, in bonds or CDs or dividend paying stocks. So right now, most of the annuities are paying somewhere between 4 to 5%, depending upon the company, which is almost 400% higher than the CDs. So that's one option. Another option is that many insurance companies have what's called an indexed annuity. So it's still a fixed income annuity, but the performance, what interest you get is based upon the performance of the stock market. So if the stock market goes up, you go up. If it goes down below zero, you actually go to zero. Your performance will never be less than zero. So you're insuring yourself on the downside of the stock market, but what are you giving up? Well, you're giving up some of the upside. I mean, if it roars up 20%, you might be at 15%. Sometimes there's a cap, sometimes it's a percentage, like you have to give up 3% of the upside. So there's different options. We can help you take a look at those if that's of interest to you. But right now, index annuities are not a great idea because it looks like the stock market's going to go down and stay there for a while. So then what else is there? Well, there's some other funds available in the private sector that you can invest in. If you're a accredited investor, which is an investor with at least $1 million of net worth, that's if you add up all your real estate, stocks, bonds, IRAs, minus liabilities. If you're worth over $1 million, you have access to some private investments. One of them is one that my wife and I actually manage. It's called the Vacation Rental Income Fund. And the Vacation Rental Income Fund was created out of my brain. I have already managed 3 different hedge funds, one with natural gas, one in commercial real estate, and one multi-strategy. But this one is purely buying vacation rentals, which is my wife's business. She's written a book about it. She's spoken around the country. She is a rock star. She's been to 46 countries. And she knows this business, and we've been doing this for ourselves ever since we've been married. And one of the things that short-term rentals allow you is that you can get much higher returns than you can with a long-term rental. Like if you buy a house, let's say you can get a $1,500 a month rent for it as a long-term rental, somebody who rents it for a year. With us, we might take that same house and make $3,000 or $4,000 a month by renting it on Airbnb and vacation rental by owner. So short-term rentals are very attractive. Also, there's a lot of exit strategies. If the short-term market looks like it's not doing as well, we can actually turn it into a long-term rental, or we can turn it into executive housing or travel nurses to advertise to them. And we also have, of course, the potential to sell the property. But one of the things this fund, the Vacation Rental Income Fund, does not have is debt. We decided a long time ago not to have any debt associated with that. So it pays a 7% income, as well as there's some capital appreciation depending upon the value of the properties that we have. The fund is also going to be geographically diverse. It's not going to be all in one city. It's going to be spread out across numerous ones so that you get some geographic diversification as well. So if you have any interest in either the annuities or looking at those, or letting me just take a look at your portfolio and give you some ideas, please contact me at david@pinnacle4.com. It's david@pinnacle4.com. I look forward to talking to you about it, maybe just giving you a second opinion. I hope you have a great day.